when Amazon undercuts competitors until they collapse. They were using a playbook written in 1870, when Google gives away products for free to dominate a market. That strategy is 150 years old. When pharmaceutical companies hide behind layers of subsidiaries and holding companies, they're using a legal structure one man pioneered. His name was John D. Rockefeller, and this isn't another video calling him evil or claiming he secretly runs the world. This is something more useful. In the next 10 minutes, you're going to learn exactly how Rockefeller built the first corporate empire, and why every major corporation today still uses his methods. Let's start with the problem he was trying to solve. In 1863, when Rockefeller entered the oil business, the industry was in complete chaos. Thousands of drillers and refiners flooded into Pennsylvania, all chasing quick profits. When oil was abundant, prices collapsed. When wells dried up, prices spiked. Most businesses failed within a year. Fortunes were made and lost in weeks. Rockefeller looked at this chaos and saw something specific: waste. He believed that pure competition was inefficient. Too many small companies fighting over the same market, duplicating effort, all operating at modest scale, and he decided to fix it through consolidation. If the problem was too many competitors, the solution was to eliminate the competition. But here's what's important. He didn't do this through violence or government corruption. He did it through 4 specific methods, and every single one of them is still used today. First, vertical integration. Most businesses specialized in one thing. Drillers drilled, refiners refined, transporters transported. Each step was a separate business trying to extract maximum profit. Rockefeller asked a simple question: why pay middlemen at every stage? So, Standard Oil started buying everything connected to the oil business. Pipelines, tank cars, distribution networks, even barrel manufacturers. By controlling every step from refining to delivery, Standard Oil eliminated costs their competitors still had to pay. This is exactly what Amazon does. They started as an online bookstore, relying on publishers and delivery services. Now they publish books, operate warehouses, own planes and trucks. Vertical integration isn't about greed. It's about eliminating the risk that someone else in the supply chain will squeeze your margins. Second, horizontal consolidation. This was about eliminating competitors directly. Standard Oil would approach rival refiners with an offer: sell to us, or we'll destroy you. And it wasn't an empty threat. Rockefeller could sell kerosene at a loss in one market to drive competitors out, knowing he'd make it back elsewhere. Smaller refiners couldn't do that. But here's the clever part. He often made the buyout attractive. He'd pay fair prices, often in Standard Oil stock. And because Standard Oil was growing fast, that stock was valuable. Many refiners sold voluntarily because they realized they couldn't compete long-term. At lower costs let him undercut competitors. Competitors failed or sold to him. His market share increased further, and the cycle continued. By 1880, Standard Oil controlled 90% of refining in America. Third, legal innovation. Here's a problem Rockefeller faced. Corporations were chartered by individual states and couldn't operate across state lines. So if Standard Oil was an Ohio corporation, it couldn't legally own a Pennsylvania refinery. His lawyers created something entirely new: the trust. In 1882, all the separate Standard Oil companies transferred their stock to a board of trustees who managed them as one entity, legally separate. This structure had never been used for business before. When states banned trusts, Rockefeller's lawyers evolved it again. They created the holding company. Standard Oil of New Jersey became the parent company owning stock in all the others. This is now standard. ExxonMobil, JP Morgan Chase, Alphabet. They all use holding company structures that trace directly back to Rockefeller. Fourth, the power of scale. Standard Oil negotiated secret rebates with railroads. Not just discounts, but rebates. They'd pay the standard rate, then get money back. Sometimes they even got rebates on oil their competitors shipped. How volume? Railroads wanted guaranteed business. Standard Oil shipped hundreds of tank cars. Small refiners shipped a few. From the railroad's perspective, cutting a deal with the biggest customer made sense. Was it fair? No. Was it legal at the time? Yes. Every major corporation does this today. They use scale to demand better terms from suppliers. They lobby for favorable regulations. They negotiate infrastructure deals. The only difference is that in Rockefeller's time, there were fewer rules. By the 1880s, Standard Oil was the most powerful corporation in America, and people were getting uncomfortable. The backlash came from multiple directions. Small businessmen who'd been driven out, populist politicians, journalists, and the public who realized one company controlled their lighting fuel. The most devastating critic was Ida Tarbell. Between 1902 and 1904, she published a 19-part investigation in McClure's magazine. She documented the railroad rebates, the predatory pricing, the backroom deals. She made the case that Standard Oil's dominance wasn't just efficiency. It was about leveraging power to eliminate competition. The series turned public opinion decisively against Standard Oil. The legal groundwork had already been laid. In 1890, Congress passed the Sherman Antitrust Act, making it illegal to monopolize trade. The case against Standard Oil wound through courts for years. In 1911, the Supreme Court ordered the company broken into 34 separate entities. And here's where the story gets ironic. The breakup was supposed to weaken Rockefeller's power. It didn't. It made him richer. When Standard Oil split up, Rockefeller owned about a quarter of the company's stock. After the breakup, he owned the same percentage in all 34 successor companies. And the market valued those companies more as separate entities than as a single unit. Investors could now buy regional oil stocks without the regulatory risk. The total market value exceeded what Standard Oil had been worth intact. Rockefeller's net worth doubled in the years after the breakup. This tells you something crucial about markets and regulation. Breaking up a monopoly doesn't destroy the value it created. The infrastructure, the expertise, the efficiencies, all of that persisted. What changed was the legal structure, and those 34 companies, ExxonMobil, Chevron, Marathon, some of the largest corporations in the world, all descendants of Rockefeller's empire. Now let's connect this to today. If you understand Rockefeller's methods, you can understand how modern corporate giants operate. Google uses a version of his strategy. They don't charge for search, Gmail, Maps, or YouTube. The product is free, making it nearly impossible for competitors to enter. Once Google dominates search, they monetize through advertising. This is giving away the core product to control the market. Rockefeller occasionally sold kerosene below cost to drive competitors out. Google gives search away permanently. Same economic logic. Big Pharma uses the holding company structure Rockefeller pioneered. Pfizer isn't one company. It's a network of subsidiaries managed through a parent holding company. This provides tax advantages, legal protections, and regulatory flexibility. It's the exact structure Standard Oil of New Jersey used, and pharmaceutical companies use vertical integration. They control research, clinical trials, regulatory processes, distribution, and increasingly, pharmacy benefit managers. The goal is to control every point where value is created, minimizing the risk that someone else captures your profits. After the 2008 financial crisis, the largest banks got even larger. JP Morgan Chase acquired Bear Stearns. Bank of America absorbed Merrill Lynch. The rationale was these banks were too big to fail. But what actually happened is the crisis eliminated competitors and concentrated power in a handful of institutions. Those institutions now have implicit government backing, giving them a funding advantage. That's not so different from Standard Oil's railroad rebates. It's a structural advantage from scale and political importance. I want to be clear about what I'm not saying. There's no coordinated conspiracy. Jeff Bezos isn't plotting with the CEO of Pfizer. That's not how power works in modern capitalism. What I am saying is that the incentives built into the system reward the same behaviors Rockefeller pioneered. If you're running a company and want to maximize value, vertical integration makes sense. Consolidation makes sense. Using legal structures to minimize taxes makes sense. Leveraging scale makes sense. Rockefeller didn't create these incentives. He just understood them earlier and more clearly than anyone else. And because he proved they worked, every major corporation since has studied his methods and adapted them. So here's the real question. The one that makes people uncomfortable. Is concentration of economic power a flaw in capitalism? Or is it just what capitalism does? Most economics textbooks say competitive markets are efficient. Monopolies reduce output and raise prices. But this ignores a basic reality. Scale provides genuine advantages. Larger firms can invest more in research, negotiate better terms, spread fixed costs across more units, weather downturns that bankrupt smaller competitors. Rockefeller's consolidation genuinely reduced costs. That efficiency was real. The problem is, what happens after efficiency is achieved? Once you've consolidated an industry, the incentive shifts. You're no longer competing to be more efficient. You're working to protect your position. You raise barriers to entry. You lobby for favorable regulations. You use scale to ensure no one can challenge you. And this is capitalism's internal tension. Competition is supposed to be the engine, but competition, when left unchecked, tends to eliminate itself. The most successful competitors accumulate advantages that make it harder for anyone else to compete. Over time, you end up with concentrated markets. This isn't conspiracy. It's just what rational actors do in a system that rewards market power. You can see this pattern everywhere. Airlines, telecommunications, pharmaceuticals, software. You start with many competitors. Over time, mergers reduce the field. Eventually, a handful of companies control most of the market. So what do you do about this? Aggressive antitrust enforcement can work, but some mergers genuinely improve efficiency. You can regulate dominant firms like utilities, but regulated monopolies don't innovate much. Or you can focus on outcomes. If prices are low and quality high, maybe concentration is fine, but that ignores other forms of power. A company can keep prices low while squeezing suppliers, underpaying workers, and using political influence to shape policy. There's no objectively correct answer. It depends on what you value. If you prioritize efficiency and low prices, concentration often delivers. If you prioritize competition, worker power, and decentralized decision-making, concentration is a problem. And if you worry about corporations shaping laws and culture, concentration threatens democracy itself. Here's what this means for you. As a consumer, you benefit from efficiencies that scale creates. Amazon delivers faster and cheaper. Google search is free and excellent, but you lose variety, economic vibrancy, and bargaining power. You become dependent on systems whose interests don't always align with yours. As a worker, concentration often works against you. When a few companies dominate an industry, they can keep wages low without explicitly colluding. You can't negotiate for better pay by threatening to go to a competitor that doesn't exist. Ask on investor Rockefeller's playbook is still the best guide. Companies that achieve dominance through integration, network effects, or brand loyalty generate outsized returns. Once a company establishes a dominant position, it's very hard to dislodge. As a citizen, concentrated economic power translates into political power. Large corporations lobby more effectively. They fund think tanks and campaigns. They shape the intellectual environment where policy gets made. Individual consumer choices won't solve this. Deciding not to use Amazon or Google doesn't change market structure. What can change it is collective action, regulation, labor organizing, political pressure. These are slower and harder, but they're the only tools that address systemic issues. Here's what we've learned. John D. Rockefeller didn't corrupt capitalism. He proved that certain methods could generate unprecedented market power, vertical integration, horizontal consolidation, legal innovation, ruthless use of scale. Those methods worked because they were often efficient. They also concentrated power to a degree that made people deeply uncomfortable. Both things are true. The question isn't whether Rockefeller was good or evil. It's whether the system he helped create serves the kind of society we want to live in. And that's a question every generation has to answer for itself. Because right now, as you watch this, the methods Rockefeller pioneered 150 years ago are being executed by corporations with reach he never could have imagined. The tools have been refined. The legal structures have evolved, but the core logic remains exactly the same. Understanding that logic doesn't give you all the answers, but it does give you the right questions to ask. And in a world where corporate power shapes everything from what you buy to what information you see to which laws get passed, asking the right questions might be the most valuable skill you can develop.